Hey guys, welcome to another episode of Basic Investment Terms. Today we're going to be taking a look at the PE ratio. Now, the PE ratio is by definition a price to earnings ratio. So it is a measure of valuation in order to determine what you're willing to pay for every single amount of dollar the company is able to earn. Okay, so classically people will say, well, the lower the PE ratio, the better it is. And the higher the PE ratio, the worse it is. Okay, but we're going to look exactly at why that could be and why that's not necessarily true every single time. So we're just going to take our good old company here, and we're going to look at its whole market value. What we want to do is take the whole market value and divide it by what it is able to generate in terms of income. All right, but what does that exactly mean? Well, you know that a whole company is divided into many stocks. And if we gather all these stocks and all the stock prices, we're going to be able to have the whole market value of the company. All right. So what we're going to do is drop down, scale down, and calculate per unit. All right. So we're going to look at the value per unit, which is the price per share. And we're also going to look at the income generation per unit, so the earnings per unit. Okay, so the earnings per share. Now you know what these metrics are. We've talked about these things in the past. So basically it comes down to a ratio of what you're willing to pay for every single dollar of earnings per share the companies can generate. Okay, now I'm going to give you guys an example here. Let's say $10 is the price per share, and just for example purposes here, we're going to pretend that remains constant all along. And the different earnings per share here for 2016 were 50 cents in the first quarter, 10 cents in the second and the third quarter, and then a little bit up to 30 cents in the fourth quarter. So the PE ratio in this case would be 10 divided by the sum of the last 4 quarters, so the total year's earnings per share, which is 1. So the PE ratio would be 10 in this case, which is a pretty good PE ratio. So this is known as the trailing PE ratio because we use the last 4 quarters earnings in order to calculate it, because we can't predict the future. But there is something called the forward PE ratio, which is used which is calculated using estimations of the upcoming quarter's earnings. All right, so it can be a metric used by people saying, well, it's going to decrease in the near future, so I'm going to invest in the company knowing that the PE ratio right now is a little bit high. Now, the average PE ratio, when you look at different companies all over, it's usually around 20 to 25. All right, so when it's lower than that, it can mean that the earnings are good, that they're underpriced, and that's usually a good thing. And when it's higher than that, it can mean the company is overpriced, that there's poor performance, or that the market expects the company to have higher earnings in the future. Okay, so they give it a higher valuation, they give it an overprice because they expect the earnings will catch up. And that is not as good. I'm not putting bad here because it's just not as good. It needs to be taken into context, guys. This is just one of many metrics you can use to evaluate a company. And more importantly, you shouldn't look at it when looking at one single company. You should look at it when comparing different companies inside the same industry, inside the same sector, and you should make sure that the companies have a fairly similar debt profile, because that can offset the PE ratio, guys, and cause you to analyze things that aren't actually there, or that are false. All right, so I'm gonna leave this here. I hope you guys enjoyed this video. If you did, leave a comment down below, leave a thumbs up, and don't forget to subscribe. Thanks.